You can ship a case of Alberta craft beer to Tokyo easier than you can ship it to Toronto. Let that land for a second. Canada, the country that helped write the rules of international free trade, that helped build CUSMA, that lectures the world about open markets, cannot get a bottle of wine across provincial lines without a bureaucratic fight. And it's not just beer. A nurse licensed in Nova Scotia cannot walk into a Manitoba hospital and start working. A Quebec construction firm cannot bid on a New Brunswick government contract on equal footing. A truck driver crossing from Ontario into Quebec faces different weight limits, different permits, different rules for the same road. This is Canada's invisible trade war, and unlike the one with Trump, this is one we built ourselves. Today we're going to answer 3 questions. How did we end up here? What is it actually costing you? And is the Carney government's push to fix it real, or just good politics? Before we get into it, a quick frame. Most Canadians, when they think about trade barriers, think about tariffs. They think about Trump. They think about some external, something being done to us. What almost nobody realizes is that Canada has been doing something similar to itself for decades, and the bill is enormous. The IMF published a report in January of this year that put a number on it. Fully removing Canada's internal trade barriers could add nearly 7% to Canada's real GDP over time. That's $210 billion in today's dollars, not theoretical future dollars. Today's dollars sitting on the table because a nurse in Halifax can't practice in Winnipeg without requalifying. For context, the U.S. tariffs that dominated every Canadian headline for the past year, the Bank of Canada estimated the average U.S. tariff on Canadian goods at 5.9%. Canada's internal barriers average the equivalent of a 9% tariff on interprovincial trade. We are tariffing ourselves harder than Trump is tariffing us. That's the frame. Let's get into how this happened. This story starts in 1867 when the Fathers of Confederation wrote the Constitution Act. They included Section 121, the clause that was supposed to make Canada a true internal common market. It says goods from any province shall be admitted free into each of the other provinces. Sounds simple. It has been anything but. For over a century, courts interpreted Section 121 narrowly. Provinces built up walls, not necessarily because they were trying to block trade, but because they were trying to regulate their own economics. Dairy supply management in Quebec, liquor control boards in every province, construction licensing tied to provincial apprenticeship bodies, professional credentials controlled by provincial colleges. Each wall made sense in isolation. Collectively, they fragmented Canada into 13 separate economic jurisdictions. By the 1990s, the problem was obvious enough that the federal and provincial governments signed the Agreement on Internal Trade, the AIT. It was supposed to harmonize regulations, create mutual recognition, and open up procurement. It didn't really work. It had too many exceptions, too little enforcement, and no teeth. Provinces kept their carve-outs, the dairy lobby kept its supply management, the construction unions kept their provincial licensing requirements. In 2017, the AIT was replaced by the Canadian Free Trade Agreement, the CFTA. Better structure, still full of exceptions. When the CFTA launched, there were 296 registered exceptions, specific carve-outs where provinces said, free trade applies everywhere, except here. That number is worth writing down. 296 exceptions to free trade inside one single country. Here's the part that doesn't get talked about enough. These barriers don't persist by accident. They persist because someone benefits from them. Provincial liquor control boards are massive revenue generators for provincial governments. Ontario's LCBO alone generates over $2 billion a year in revenue. Opening up alcohol to interprovincial competition means giving up that revenue stream. Provincial licensing bodies, medical colleges, law societies, engineering associations, control who can practice in their jurisdiction. More competition from out-of-province practitioners means downward pressure on fees and wages. The incumbents have every incentive to keep the gates closed. Government procurement rules that favor local suppliers protect local jobs and local political constituencies. A New Brunswick premier who opens procurement to Ontario firms is handing his opponents an attack ad. This is the political economy of why the walls stay up, even when everyone agrees they're bad. The benefits of keeping them are concentrated and vocal. The costs are diffuse and invisible. Let's get specific about the cost because the headline numbers can be misleading. The IMF's $210 billion figure is a long-run estimate of the gain from full elimination of all non-geographic barriers. That's the ceiling. That's the best-case scenario where every barrier comes down. A more conservative read comes from TD Economics, which notes that a 2017 Bank of Canada study estimated just a 0.2% annual lift to GDP from a significant but partial reduction in barriers. The real number is probably somewhere in between, meaningful but not a silver bullet. What's clear is where the costs land. On consumers. Research from Queen's University estimates interprovincial barriers inflate consumer prices by between 7.8 and 14.5% on affected goods and services. That's not a tariff from Washington. That's a self-imposed tax on your grocery bill, your professional services, and your insurance. On small businesses. A small manufacturer in New Brunswick who wants to sell into Ontario faces compliance costs, different labeling requirements, different certifications, different procurement rules that a large firm can absorb, but a small firm often cannot. Internal barriers are a de facto advantage for incumbents and a barrier to entry for challengers. On workers. A registered nurse moving from Alberta to Ontario has historically had to go through a requalification process that can take months. A plumber licensed in Saskatchewan cannot simply start work in Quebec. This suppresses labor mobility, traps workers in lower productivity regions, and drives up costs for employers who can't fill positions. On Atlantic Canada specifically, the IMF report is blunt. Smaller provinces bear a disproportionate burden. Prince Edward Island could see gains of nearly 40 percentage points in real GDP per worker from full liberalization. The maritime provinces are most trapped by internal fragmentation, and they're the provinces least able to absorb the cost. In a video last week, we talked about Canada's productivity crisis, the decade-long slide that has pushed Canada below the OECD average for GDP per capita for the first time in history. Interprovincial trade barriers are a direct input into that crisis. When capital and labor can't flow to their highest value use across provincial lines, productivity stagnates. A tech firm in Waterloo that can't easily hire a specialized engineer from Montreal because of administrative friction is a less productive firm. A construction company that can't bid on contracts in 3 provinces simultaneously is a less efficient company. The IMF is explicit. The gains from full internal liberalization are driven not by short-term demand effects, but by higher productivity, more efficient allocation of capital and labor, stronger competition, better scale for high-performing firms. This isn't an abstract policy debate, it's a direct explanation for why your wages haven't kept up. To be fair to the Carney government and the Trudeau government before it, there has been real movement. In June 2025, Bill C-5, the Free Trade and Labour Mobility in Canada Act, received royal assent. It came into force January 1st, 2026. The federal government removed all 53 of its own exceptions to the CFTA. That's genuine progress. In November 2025, all provinces and territories signed the Canadian Mutual Recognition Agreement, covering most goods, tens of thousands of products, with barriers dropped starting December 2025. A trucking MOU is in progress. A financial services chapter is expected by May 2026. Direct-to-consumer alcohol sales between provinces, the beer example from the beginning of our show, are being implemented by most provinces. So things are moving, that part is real. Here's where you need to be clear-eyed as an investor. The December goods agreement excluded food, beverages, tobacco, plants, and animals. Alcohol, one of the most high-profile and politically symbolic barriers, is only being addressed through a separate, slower process. More importantly, services. The IMF report is unambiguous that services account for roughly 4/5 of the potential GDP gains from full liberalization. Finance, telecommunications, transportation, and professional services, these are the sectors with the highest barriers and the deepest economic ripple effects. And services were largely exempt from the November 2025 agreement. The CCPA, the Canadian Centre for Policy Alternatives, makes a pointed argument worth hearing. The big GDP numbers politicians love to cite may overstate the gains. Their argument is that when you look at what actual trade barriers exist, such as alcohol sales, some trucking regulations, procurement policies, the low-hanging fruit was picked long ago, and the remaining barriers are either politically impossible to remove or legally constrained by constitutional provincial jurisdiction. They also raise a legitimate concern about mutual recognition specifically. If every province must accept the least stringent standard of any other province, that's not free trade. It's a race to the bottom on safety, environmental, and consumer protection standards. So where does that leave you and I? The political momentum is real and durable. The Canada-US trade war has created genuine public and political appetite for internal free trade that didn't exist before. That's a tailwind. But the easy wins, goods, some labor mobility, trucking, are being addressed. The hard wins in services, professional licensing, procurement require provinces to give up real revenue and real political power. That's a multi-year project, not a 2026 catalyst. The sectors to watch if service liberalization accelerates are financial services, telecommunications, construction, and professional services. These are the sectors with the highest current barriers and the largest potential gains. Any company operating interprovincially within these spaces is currently paying a friction tax, and any meaningful reduction in that friction flows directly to margins. The real scenario for 2026 is meaningful progress on goods and labor mobility, with services reform beginning but incomplete. That's still worth pricing in, but don't expect the full $210 billion to materialize this cycle. Here's the bottom line. Canada has spent the last 18 months furious about a trade war with the United States. Rightfully so. But in the same period, the evidence has become undeniable that Canada has been waging a quieter, slower, more expensive trade war with itself. The IMF says the internal barriers we've built cost the equivalent of a 9% tariff on interprovincial trade. Trump's tariffs on Canada averaged 5.9%. We are doing more economic damage to ourselves than he's doing to us. The good news, though, is that unlike Trump tariffs, these barriers are entirely within Canada's control to dismantle. The political will is finally there. The federal legislation is in place. Provinces are signing agreements. The bad news is that the hardest barriers, the ones in services, the ones protecting entrenched professional and commercial interests, are the ones that account for the largest potential gains, and they're moving the slowest. For Canadian consumers and investors, the framework is this: internal trade liberalization is a real, underappreciated tailwind for companies operating interprovincially, particularly in financial services, construction, transportation, and professional services. The gains here will be gradual. They're not yet priced in, and they represent one of the few levers for Canadian economic growth that Ottawa actually controls. 3 things to watch. First, whether the financial services CFTA chapter enters into force by May 2026 as promised. Second, whether provinces move on professional credential mutual recognition. This is the single highest impact labor market reform available. And third, whether services are brought into scope in the next phase of internal trade negotiations. Well, that's today's Canadian Macro Brief. If you found this useful, please subscribe and hit the notification bell and comment if there's a topic that interests you. We do this every Sunday. All sources are in the description. I'm Steve, and as always, nothing here is financial advice. Do your own research and speak with a qualified financial advisor before making any investment decisions. We'll see you next Sunday. Good night.